All right, let's move on to our next segment. I think we have Aaron talking about the largest retailer in the world, or home retailer in the world. It's Home Depot. Brennan thought it was Rona, but it's. I had to school him today and tell him it was Home Depot.
I thought it was PV Mart.
Yeah, well, they gave you your first job, didn't they?
They did give me my first job, yes. And unfortunately, they just recently went out of business.
Okay, so yeah, my pleasure, Ryan. We're going to take a look at Home Depot. This is a company that everybody, I'm sure, has bought products from many times in their life. Certainly, if you
I was there this
any
weekend.
work on your house,
I
you were there this weekend.
Soil.
I was there not too long ago, and we all know the brand well. Big U.S. company. So Home Depot is the world's largest home improvement retailer. They have 2,350 big box stores in North America. Symbol is HD. The price is $378, $340 billion market cap, and a 2.4% yield. And is also a dividend grower as well. So the company has it's been volatile with the overall market over the past year, and then also year to date. So year to date, the stock price is down about 2.5%. This is versus the S&P 500, which I believe is now up 1% for the year. Although I have to check on that because it changes so quickly, even just throughout the day. But fairly typical share price activity here from Home Depot. The company did just release its Q1 financial results and updated its guidance. So we're going to take a look at those results. One of the reasons why I think that Home Depot is an interesting company to look at right now, everybody's looking at the Q1 results from the lens of how are tariffs impacting the financial performance of companies? How are they going to impact prices? How is consumer spending and any declines there having taking its bite out of performance? So far in Q1, I think that we're just starting to see some of the effects trickle in, but it is interesting to see or hear what the management commentary is from some of these companies, just in the context of the macroeconomic picture and all of these tariffs and uncertainty. But looking at Home Depot's Q1 results, net sales $39.9 billion, up 9.4%. Comparable same-store sales were actually down 0.3%, although in the US they were up 0.2%. Adjusted EPS $3.56, down 3%. They missed analyst estimates by just a couple of cents. I believe analysts were estimating about $3.60, $3.62 in earnings. Gross margin down 70 basis points, primarily due to foreign exchange. And then operating margin was down 120 basis points in the quarter. So in terms of management commentary, what was management saying about the results and just the overall environment? Well, very interesting is that they're actually saying, the CEO is saying that they will not raise prices to offset tariffs. So they're making this commitment. I know that, some companies are already starting to raise prices. Some are being very vocal about the reason why and highlighting that it is in fact tariffs. But Home Depot is saying, at least for now, that they won't. We will see. I mean, really, this is a promise that you can't make. It really depends on how badly tariffs impact the company's costs. We don't know what the tariff structure is going to be in 6 months or a year from now. It all seems very chaotic. So there are scenarios where if they don't raise prices, they would essentially be losing money to be in business. And I'm sure they're not going to do that. So, but looking at their targets, over 50% of their sourcing, they say, is in the US. They're targeting less than 10% reliance on any non-US country by next year. Some of the opportunities that they're highlighting just in terms of future growth, expanding the size of the company in terms of new store openings, looking at 13 new store openings for 2025, omni-channel investments as well, essentially expanding channels, so more online, more partnerships, and then more stores. Now with 2,530 stores, obviously adding 13 a year is barely moving that needle, but it all helps. And typically when you're adding new stores, you're adding them in areas where the profitability is probably going to be higher than the average in your existing portfolio. Now, in terms of headwinds, a few of the things that the company highlighted were just the cooler spring weather, and higher interest rates as well, slowing down the large renovation projects. So they've noticed that. In terms of macroeconomic conditions, we also do have to take into account that this is a market that does have cyclicality in it as well. If people don't feel confident in their job, if they don't feel confident in their income, and as well if interest rates are high, they're going to be far less likely to do renovations and upgrades on their house. So that will affect the company depending on how the economy trends over the next several quarters. Now, looking at the balance sheet, total debt 51 billion, net debt of just under 50 billion. And I have a net debt to EBITDA multiple of 2.4 times. So I think that is a perfectly healthy debt leverage ratio for a company like Home Depot, particularly brick and mortar, where you would expect there to be some debt because it's a capital intensive business. Now, guidance and valuation, what are they looking at for next year? So this is for 2025. They're looking at net sales growth of about 2.8% next year. So these are the midpoints of the guidance. Comparable sales growth up about 1.0% next year. In terms of EPS and profitability, they're essentially estimating flat earnings in 2025, actually decline in the low middle digits. Now, when we look at this in terms of valuation, based on the 2025 guidance or the midpoint of that guidance, 25 times is essentially what the stock is trading at right now. But if we look at the 5-year historical on it, Home Depot is really traded closer into the low 20s. So not substantially above the historical, but certainly above the historical and meaningfully so. Now, our take on Home Depot, so the largest home retailer in the world, this does give it an advantage, particularly in a scenario of rising input costs from tariffs, maybe some macroeconomic contraction. It gives them an advantage relative to other retailers because they have that significant cost advantage, that diversification in order to deal with some of these other negative headwinds. Also consistent profitability and a good dividend profile. Prudent leverage, so 2.4 net debt to EBITDA. They're sitting on a strong financial foundation. I'm going to expect that the free cash flow is going to continue. There's going to be buybacks. There's going to continue to be dividend increases. But when we look at that valuation, trading at 25 times forward earnings compared to the historical in the 20 to 22 times range, given the fact that, we're in an environment here that whereby the uncertainty is much higher than what we've seen over the last 5 years, I would say, for the most part. I mean, obviously, there's been times like COVID, other times over previous years where there was a lot of uncertainty. But certainly with the tariffs, a lot of the macroeconomic headwinds, we've seen some contraction in consumer spending and consumer confidence. A lot of this really comes together to say this is not an ideal, rosy operating economic environment for the company. So I would not expect for them to trade at a premium multiple in that type of environment. And then the risks, of course, as I had said, all the tariff uncertainty, the interest rate headwinds. So we don't see any value in the stock currently. It's not a company that we would buy at the current valuation. Long term, I think that it's going to continue to be a leader in the space. Home renovation isn't going anywhere. I think they're going to continue to be profitable, depending, of course, on what happens with their input costs. But it's not a company where I see any value in the near term. Certainly, I would want to buy it at a discount to its historical right now. If it were trading in the 15 to 20 times price to earnings range, then it starts to look interesting. But at even a moderate premium to the historical valuation, it doesn't really interest me that much. But we'll keep an eye on it, and if there's an opportunity, certainly we would pounce.
Yeah. I've got construction going on right now outside, so it's kind of like a nice little segue. Not that my segment will have anything to do with that, but one thing, I was in Home Depot last weekend buying a couple pails, and I noticed when I was checking out, it was all self-checkout, and there was just one lady who would come around and help you, do the checkout. I don't know if when you guys were just there, if that was the case in Vancouver's Home Depot. Ryan, you were saying that you were just there.
Yeah, basically, there's one person there and they'll help you, but a lot of it was self-checkout.
Yeah,
So
self-checkout.
there is a push towards that, and less employees potentially in the store, or maybe they have employees helping you around there. But they're certainly at the checkout. We're going towards self-serve for sure, which is interesting and potentially helps margins. Maybe that's a way they're able to gain some on the profit side, and then the tariffs that you could lose some on that. So that may be a way offsetting that. I'm not sure going forward, but yeah, I think Aaron, the summary there is, if you're looking at premium valuations in a more uncertain environment, it's probably just a whole, you hold on and you're not buying more or buying any at this point. You're waiting till you could get maybe a good company, but more of particularly when you're facing uncertain times, I'd probably want a more discounted multiple. I think that's what you're saying, right, Aaron? I believe.
Yeah.
That's basically, yeah, that's a good company. But yeah, when you're not buying it in an ideal scenario, then obviously you want to pay a little bit less. And I don't see that. I don't think that, and I think this is in a lot of stocks. I just don't think all of the risks are really
recent commentary over the weekend out of some of the big bank heads saying just the markets look complacent right now after the drop and then the pop back up. There are significant headwinds facing the market, so I'm not sure how a bounce right to almost where we were or slightly higher than where we were ahead of all this tariff noise is justifiable. The backward looking nature of Q1, like you're not really seeing any tariff effects in there. You're going to start to see that in the next quarterly announcements. It kind of ceases to amaze me, or it doesn't cease to amaze me, how surprised the market can be when you're getting punched in the face saying that, you're going to have weaker quarters coming up, and then the weaker quarter hits and it's like, so maybe the market will be surprised. It shouldn't be surprised that there's going to be a hell of a lot of noise in these numbers. I would think there's even going to be some on the positive side where companies bought from a supplier, and that supplier is going to do more to stuff their inventory, and it's going to look like a gain in that quarter. It may look like to an investor a sustainable gain. I just think there's going to be a lot of strange one-time type items, and then there's likely just a freeze up in spending that's going to affect over the next several quarters until we can get some certainty and people can start to deploy on projects. So yeah.
I wonder too, sorry, I was just going to, on that note, just as you were saying there, 9.4% growth in revenue. I'm wondering as well, how much of that is coming as well from people who are like, they're expecting that prices are going to increase. They know they have a reno coming up. So there
had to be some of that,
a lot of their stuff. And it's like, maybe this is the Q1s are actually the good quarters, right? For some of these companies, and then you're going to start to see it.
Yeah, there had to be some. Depending on what, if you were looking for a car, people may have went out and said, "Oh God, these are all going to get tariffed." I know I'm going to buy one in the next 3 months. I'm sure some people were pushed into buying a vehicle, near term ahead of that. If you thought there was going to be a 10, 25% tariff, you were going to react. I saw dealerships putting on, we're still no tariffs, or there's no tariff. Get our no tariff inventory, like those things were out there. So people may have been pushed into that, and that may have drawn some sales backwards into that quarter from where they naturally would have came.